Should you go long or short? If the market is trading above yesterday's high, go long or avoid going short. If the market is trading below yesterday's low, go short or avoid going long. And watch to see who is trapped after 30 minutes of the market opening, bulls or bears. Then go in the opposite direction. Trading is a zero-sum game. You need to know who you are profiting from. Watch until the end for a more detailed explanation of simple market patterns you can use to be a successful day trader. This is for educational and entertainment purposes only. Please consult a certified financial advisor before making any trading decisions. We are not responsible for any losses you might incur following any of these strategies. Trading is not so much about strategies, it is primarily about psychology and money management. If you are in it for the long haul, you need to be disciplined and not lose more than a maximum of 1% of your trading capital daily. Assuming you have taken care of this aspect, here are some simple rules or patterns for day trading. Towards the end of the video, we will explain how you can apply all of these strategies and pyramid, like professionals, to day trade and maximize gains, minimize losses, and stay disciplined. Rule 1. Buy above yesterday's high and sell below yesterday's low. If the market is trading above yesterday's high for 15 to 20 minutes, go long by buying an ETF, futures, or selling a put. Buying a call might not work well due to time decay. Waiting 15 to 20 minutes helps rule out a false breakout. Similarly, sell below yesterday's low if the market holds there for 15 to 20 minutes. Buy inverse ETFs, sell futures, or write call options. Buying puts may not be effective due to time decay. Apply the same rule to weekly highs and lows as well. Go long if the stock trades above the weekly high for 30 minutes, and sell if it trades below the weekly low for 30 minutes. The key thing is waiting to determine whether you're experiencing a breakout or a false breakout or a breakdown. The longer the time period, the longer you should observe. For yesterday's high-low, observe for 15 to 20 minutes. For the weekly high-low, observe for 30 to 45 minutes. To give you some examples, on 31st October, the S&P traded between 5,775 and 5,750 in the morning for 30 minutes, then broke down. The previous day's low on 30th October was 5,811. For the last 5 days, the market has been opening above yesterday's high and pushing up. You can observe this and see for yourself. Note that it occurs 70 to 80% of the time. Often, there are news events during market hours that break patterns, so there is no guarantee for anything. It is more important to know what not to do than what to do. You can always get out with your stop loss and choose not to trade if you are not convinced. However, if you go against this rule, chances are you will incur losses more often. Note that once you have taken a position, you can expect a move of 20 to 30 points in your direction, and then take profit or keep riding with a trailing stop loss. You can also pyramid in the direction of your trade, which we will explain towards the end of the video. We are talking about day trading in this video. You must exit all positions before the market closes, whether you are at a profit or loss. Rule 2. This is the most important rule for day trading. A position that fails to move in the money within 30 minutes of market opening, or even 30 seconds in some cases, may not turn profitable until the final trading hours. This 30-minute window includes yesterday's closing moments. Watch the market for 30 to 45 minutes after opening. If shorts are trapped, consider going long. If longs are trapped, consider going short. Trading is a zero-sum game. You must understand who you're profiting from. You have to observe yesterday's high and low in conjunction with the 30-minute rule to make the final decision about whether to go long or short. Sometimes the market might not go above yesterday's high or break below yesterday's low. In that case, the 30-minute rule is something you can fall back on. Note that you are not just checking who is trapped since the market opened, but also who got trapped in yesterday's final moments. For example, when the market opened and traded above 5,960, you know that not just the morning shorts between 5,950 and 5,960, but also a short position at yesterday's closing of 5,929 is trapped. Most often, the market does not oblige and give people betting in the wrong direction at closing a chance to break even or make a profit. Let them remain trapped and you trade in the opposite direction. Study historical charts to see for yourself this behavior. Here is another interesting pattern you should observe. If yesterday's low acts as support, it might go back to test yesterday's high. Watch out for this. This happens when the market might be in a mood to remain sideways or not break the recent high or low when option writers are in control of the market. That is why when a high or low is taken, you should observe it for some time before concluding if it is a breakout or breakdown. Always be mindful of the final hour market mood change. Be on alert for any trend reversal. Most often, people who remain trapped in the morning lose money. Sometimes the market might reverse to give them a chance to break even or make some profit. The trade working in your favor since morning might turn into a loss. You can close positions with trailing stops, which we will explain later. Rule 3. Keep an eye on moving averages, especially the 20 and 50 DMA. The first bounce from the 20, 50, 100, or 200 DMA can often be bought, as short sellers tend to cover quickly. However, if the price tests those levels again, wait for a double bottom confirmation before re-entering. Similarly, the first stop at the moving averages should be shorted. The second time, wait for the double top to be confirmed before selling. This double top or double bottom can occur at any price point, not just at the moving averages. It happens more often near the moving averages. Apart from the 3 rules, here are a few important things to keep in mind. Consecutive weekly losses can indicate a shift from an uptrend to a downtrend. Be extra cautious when going long, and consider this in conjunction with the 3 rules. 2 consecutive positive days may signal an upward trend reversal. 2 consecutive positive weeks are often a strong buy signal. The dual moving average crossover strategy is a popular and straightforward trading approach used to identify potential buy and sell signals. It involves 2 different moving averages, a short-term and a long-term average, to track price trends. Typically, the 20-day moving average, 20 DMA, and the 50-day moving average, 50 DMA, are used in this approach. When the 20 DMA is above the 50 DMA, it generally indicates a bullish trend, and it's a signal to buy the dips. When the 20 DMA is below the 50 DMA, it is often seen as a bearish signal, and it's a signal to sell the rally. Just keep this in mind. As day traders, you should focus primarily on the 3 rules mentioned earlier. Additionally, the 100 and 200 DMAs are strong support, but below that, you will find more shorting opportunities than going long. Also, when the market falls from a peak, it often attempts to go back to the old high. If it doesn't retrace more than 60%, that is the point to initiate a short. If you don't trade futures, you can consider buying inverse ETFs like SQQQ or SPXU. Check out our other video on leveraged ETFs and inverse ETFs. If you have options selling expertise, then go short by writing a call or go long by selling a put. Even if the market doesn't move in your favor, you might profit from time decay. Option sellers make money 70 to 80% of the time, but when they lose big. Make sure to get out with an appropriate stop loss. Avoid buying options for day trading due to the slow midday time period, as you might lose out even if you are directionally correct. Note that you can still profit from buying options 20 to 30% of the time, and sometimes huge profits come from buying options, but you will have to bet smaller amounts as more often you're going to lose. Big fund houses do month-end and quarter-end window dressing. So in a positive month, the market generally rallies in the final hour. In a negative month, bears take control and slide in the final hour. so you know which way to go. Now let's discuss the only day trading strategy that works consistently. We will use the S&P 500 ETF to explain the trading strategy, but a similar approach can be applied to any liquid ETFs, stocks, or futures. You can spend thousands of hours reading charts and analyzing patterns, but if you are not applying this strategy, you will never be a successful day trader. This strategy is not applicable to options due to time decay. It is mainly designed for day trading stocks, ETFs, or futures. This strategy may not work for positions held beyond a day due to the risk of overnight gaps, which won't allow effective management of stops. If you're a long-only trader, you could wait 30 to 45 minutes after the opening to check the mood for the day. If the market is trending higher, buy with an appropriate stop loss, as most traders do, and take profits at intervals. However, traders who average down can incur large losses if they're wrong. Here's an alternative strategy. You might only have a 20 to 30% success rate, but one big profit can offset several losses, and you'll avoid large loss days. This is key to trading: small profits, small losses, and occasional big profits to grow your capital. You can use a percentage of your trading capital for this strategy and allocate the remaining amount to whatever you are comfortable with until you have consistently applied this approach and learned from it. SPY or SPY is the ticker symbol for the SPDR S&P 500 ETF Trust, which is one of the most popular exchange-traded funds, ETFs, in the world. Our SPY trading capital allows us to buy around 40 lots, but if we're wrong in the first few trades, we could quickly lose our capital. So we use a pyramiding strategy, buying no more than 30 units to keep some buffer for losses, ensuring the strategy remains intact even after consecutive loss days. There are two types of pyramiding strategies: buying less at each market rise or buying equal amounts at each level. You can experiment with both. The problem with a larger base is that if you're wrong, you'll lose more with your stop. The problem with equal size at every level is that your average buy price will be higher, but you'll lose less if you're wrong. We typically use a pyramiding strategy with 30% at the base. If we have 30 lots to buy, our pyramid might look like 10, 8, 6, 4, 2. SPY can move around 1% on a good trading day, so our pyramid layers will be built approximately at a 0.2% rise of the instrument. Now, let's dive into building the pyramid and managing trailing stop losses during the trading day. The first trade would be 10 SPY units with a 2-point stop loss. We won't buy at the opening, but after 15 to 20 minutes, as most people who bought yesterday in after hours or in pre-market exit at the open when they see some gain. Fresh institutional positions get built after that. Waiting allows the trades to settle before building the pyramid. Here you need to also apply Rule 1 or 2 and see if it's appropriate to go long. Otherwise, you can go short with a similar strategy. Also, check if the market is trading near support, then you can pyramid from there if the support holds. For the first position, the planned loss is $20. If the market hits our stop, we might start rebuilding only if the market goes above the morning high or bounces from a key support. If not, we stay out with a $20 loss. If the market moves up, we make our second trade, say at 531, with 8 SPY units and a 2-point stop loss. If the market continues to rise, we make our third trade. At this point, we will raise the stops for the first 2 positions, bringing the first position to the break-even level and tightening the stop for the second one. We continue this process to build the pyramid and manage stop losses by moving them up for previous trades. You don't have to strictly follow this, but it gives you an idea of how to avoid booking profits too quickly and keep adding to winning positions, staying in the game longer. You're aiming for a big profit day, but are okay with small losses or small profits. With this strategy, you'll never have a big loss day, which usually happens when averaging down. If the market keeps pushing in one direction and closes at a high, you'll make a big profit, which often happens once every couple of weeks, or more frequently in a trending bull market. If the market reverses, stay out and let the market hit your stop wherever they are places at that point in time. With this strategy, having 2 to 3 big profit days can easily make you about $300 in a month, roughly 1.5% of your SPY trading capital. In a year, this could result in an 18–20% return, regardless of market conditions. Also, as you get better with the rules, you can determine which days are good for going short versus long. You might have more big profit days trading in both directions. As your trading capital increases, adjust your lot size proportionately to achieve higher profits. Here are some guidelines on pyramiding. Never start pyramiding below yesterday's low. Never start pyramiding near a supply zone on the chart. In a bull market, it's okay to start pyramiding after a gap down opening. In an uptrend, it's okay to start pyramiding after a gap up opening if it holds the level for 15 to 20 minutes or opens above yesterday's high. Finally, why day trade? You never know what will happen in the market the next day. Whether the Fed will cut rates, by how much, or how the situation in Iran and Israel will unfold. You don't know which political party will come to power. You can come back each day with a fresh mindset. If a trade doesn't work out, you can try again the next day. Holding positions overnight can add unnecessary stress. While trading, stay aware of key events. Mute the TV and rely more on price action than on what commentators or analysts are saying. Don't get too caught up in profit or loss. Celebrate a trading day if you don't break your own rules, regardless of profit or loss. Thank you for watching. This content is for educational and entertainment purposes only. We do not recommend buying or selling any of these instruments or applying any of these strategies without consulting a certified financial advisor. Subscribe to our channel and hit the bell icon for more informative content in the future.